Get out of gold. That's the headline from the futures pits as gold touched a 4-month low and has now fallen 3% in just a week. It's near correction territory. The whole base complex is down. In fact, silver also hitting a 4-month low. What's behind the selling? Welcome to Futures Now. I'm Jackie DeAngelis. We're going to answer that question with Peter Schiff and also the CEO of Pan American Silver. It's one of the largest publicly traded silver miners. But let's go ahead and start with our futures crew first. Rich Chisholm is in Chicago on the floor of the CME. Anthony Grisanti is at the NYMEX. Rich, let's start with you. Before you give me your trade, let's just talk about key levels for a second and what we went through here today. What are those levels? What does it mean for gold?
Jackie, we've been talking about this for a week. 1668, your 200-day moving average. We've been buyers against that level for months. Once we close through it, pass through it today, it becomes resistance. Now we're sellers. Most traders that trade gold, the CTAs, hedge funds, are very technical in nature. They're not fundamentalists. They're technical traders. Once we start breaking, it becomes Niagara Falls through a garden hose, and that's what's happening. If we close on the lows today, we're probably going to see new lows into tomorrow.
Anthony, out to you. Do you agree with what Rich is saying? Are those the same levels that you're watching, or are you looking at it a little different?
No, Jackie, those are exactly the same levels I'm watching, and I was talking to traders in the pit this morning. Rich hits the nail right on the head. These are hedge funds, these are CTAs, these are your mom and pop investors in silver and gold that are taking these profits right now. And when you look at commodities overall this year, there's not a lot of profit to be made in these. These are two that they are, and they are taking those profits.
Okay, all right. I'm going to go out on a limb here and say that our next guest views today's sell-off as a buying opportunity. Peter Schiff is the CEO of Euro-Pacific Capital and the noted author of many books, including Cash Proof: How to Profit from the Coming Economic Collapse. Peter, always great to have you on the show. First question, the dollar's lower today. Central banks, they're printing money. This has traditionally been good for gold. Why is it not working now?
Well, I think what's happening right now in the currency market is it's more of a euro and yen story. They're selling off the yen just like they're selling off gold. The yen has been a safe haven for a lot of Europeans who wanted to get out of the euro. Maybe they didn't like the dollar that much, so they bought the yen. But you've had a very strong euro, not only against the dollar, but particularly against the yen. I think you had selling coming out of Europeans who now feel that the worst is over for Europe. There's not a worst-case scenario looming on the horizon where the euro is going to fall apart. So that might be one of the other reasons that you're getting a temporary decline in gold. But, before I came on, you talked about how gold was down 3%. Should people be selling their gold? When the stock market's down 3%, you don't do shows on people. Should everybody bail out on their stocks because the market's down 3%? Look, the market's going to go up and down in the short run. There are plenty of speculators that are going to move around the market. But you mentioned the mom and pops. They're not selling. Those are my clients. I've got a precious metals company, Euro-Pacific Precious Metals. People can go to schiffgold.com. None of our clients are selling. They're buying. These are leveraged speculators, maybe guys that are in hedge funds that are selling. The people who have been buying gold for the past 5 years, 10 years, my clients, individuals who are buying gold as a store of value, as a hedge against inflation, they don't care about the short-term market noise. All they do is they use it as an opportunity to buy more.
Hey, Peter, John Paulson is out there. Of course, he's a big holder of gold. Do you think that he's one of the funds that might be selling at this point?
Well, we know there was what J.P. Morgan just put a couple of his funds on their liquidation list. And, I'm sure that a lot of people chased his performance. He had a hedge fund, so did we, by the way, that shorted subprime that did very well in 2007. A lot of people saw those huge returns, and so they sent him money, assuming that they're going to make that kind of score again. That's almost like a once-in-a-lifetime trade. But I think a lot of money just went to John Paulson because he made money shorting subprime, and it's all short-term money. And maybe they're becoming impatient. They were looking for another quick score, and they didn't get it, and so they want their money back, or they're looking for something else that's going to be hot. And I think that's an opportunity. It's unfortunate for the Paulson investors who aren't patient enough to ride this thing out. I was talking about the problems in the mortgage market for years before the thing melted down. This is a bigger problem. I think, people could make a lot of money in gold and gold stocks if they're patient. But unfortunately, there's money on Wall Street that's not patient. And I advise other people who understand the fundamentals, because a lot of the people who invested with Paulson probably have no idea about the fundamentals. They just sent him money because he had a hot hand. And now they want it back because it's cooled off. But they don't understand the dynamics behind the market.
Okay, well, let's talk about some of those fundamentals right now. If we do have people out there looking at the trend downward in gold right now, maybe a little bit nervous about it, you say that you got to stay in gold. There's a lot of physical buying right now. Talk to me about the physical buying and how that incorporates into your thesis.
Well, you're having record physical demand. Not only in America, but around the world. Think about it. What are you going to do if you want to save your money? If you don't want to buy stocks or buy real estate, you just want savings. You're not really sure what you want to do, but you want to have money available for the future. What are you going to do? You're going to hold dollars at 0% with Ben Bernanke promising to print till infinity. You're going to hold euros. You're going to hold the yen, the Chinese RMB. There's no currency that you can hold and be confident in its future purchasing power, but you can hold gold. You can hold silver. It's very expensive to mine this stuff, and you've got a mining CEO coming on. He'll tell you cost of mining are going through the roof because of all the inflation that central banks are creating. So people are figuring this out. They're voting with their feet. They're holding something with intrinsic value that has historically been money that people like Ben Bernanke can't print.
Hey, Peter, Rich Ilchishin at the CME Group in Chicago. Explain to the gold bugs why your thesis fundamentally should be pushing gold prices higher, but we haven't done anything. And in fact, we're making new lows as we speak. How is it possible with the geopolitical risk, with Iran, Israel, with the QE1, 2, and 3, that gold is not taking off? And what is that catalyst in 2013 to get the market higher?
Well, you're looking at it from a short-term perspective. Take a step back and look at the market over the last 12 years. Gold didn't move from under 300 to close to 2,000 without a fundamental catalyst, without all this central bank money printing. But it doesn't go up in a straight line. Look, if most of the people in the world understood the fundamentals like I do, yeah, gold would be a lot higher right now. But the problem is, or the opportunity is, most people have got it wrong. Just like a lot of people were paying premiums to buy subprime mortgages in 2006 and 2007. I knew they were worthless, but most people didn't realize that until it was too late. So yes, gold should be a lot higher, but you don't want to overestimate the intelligence of the financial community. They don't understand the dire straits the U.S. economy is in. They actually think that Ben Bernanke knows what he's doing. They think he has an exit strategy. They don't understand what's going to happen, just like they didn't understand what was going to happen to the mortgage market or the banks in 2007. But eventually, the fundamentals always win out. And one of these days, you're going to see a huge, huge upward move in the price of gold. And then you're not going to be wondering why gold isn't at 2,000 or 3,000, because it'll be there. And the people who didn't buy it when it was down at 1,600 or 1,700 are, they're the ones that will have to chase the market and buy it up there.
All right, Peter, you're going to stay with us. Of course, we have plenty of more questions for you. But, Rich, I want to bring you back in here, go out to you, rather. How are you trading gold right now in the short term? What are the levels that you're watching, and how does this play out for you right now?
Well, listen, short term, I'm bearish. I'm a trader. This isn't a long-term investment strategy. I'm going with the flow. Long term, I'm bullish. Been bullish for the last 10 years. But listen, take a look at every economic indicator, if you will, technical indicator, if you will. The ADX, the MACD, and all the others, they're pointing down. We broke the 200-day moving average. And in fact, big buyers last time around at the 200-day moving average were China and India. But with the dollar versus the rupee, the Indians aren't backstopping gold. So the market continues to sell off. And hedge funds and CTAs and all those other guys start looking at their profits dwindling. So you could have got out of gold at 12%. Now it's 10, 8, 7, 3. At some point you pull the plug and say, listen, I'll get back in. Take a look at last year's move. This market sold off just the way it did this year. And I think ultimately it'll be a good buying opportunity down the road, maybe a couple of weeks. But here I'm short. So what I'm doing is I'm selling the Feb mini gold contract at 1668. Why is the 200-day moving average? Support is now resistance. I'm placing a stop 10 points higher at 1678, so that's above the previous high from the new low. My target's going to be 1638, so the risk here is going to be basically risking 10 to make 30. I like the trade.
Hey, Anthony, out to you. What do you make of that trade? Do you like what Rich is saying here?
Yeah, Jackie, I'm in Rich's camp. I'm definitely on the short term. I am definitely bearish gold right now. You know, he mentioned the Indians. Their demand is down 11% on the year. We do have, the QE going, 3 and 4 going, and gold hasn't broken above the 1750 in about a month now. At the $1,800, it failed. So definitely short term, I'm bearish gold. I'm bearish silver. Both of these metals.
All right, let's go ahead and bottom line this trade with the risk reward. Rich is no longer bitten by the gold bug. He's getting short at 1668. He's looking for a 30-point move lower, but he's using gold mini contracts. Remember that each dollar move in the minis is worth $33.33. So this trade risking $333 to make about 1,000. Bit of a tongue twister there, but we got it.